Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Star Entertainment Limited annual report. China Star Entertainment Limited offers a diverse range of businesses and services across various sectors. At its core, the company engages in film-related activities such as production, distribution, licensing, and investment. This includes artist management and agency services, as well as holding cable rights. In addition to film operations, China Star also provides property development and investment services, including property agency, building management, and construction project management. The company has expanded its reach into e-commerce through the development of a multi-channel network platform for live streaming sales. Furthermore, China Star offers various ancillary services such as nominee services, film production management, catering, and prop rental. It also holds song rights, trademarks, and copyrights, which it licenses to other parties. The company's multimedia and entertainment operations include media business development, private label product sales, and corporate planning. Overall, China Star Entertainment Limited has diversified its portfolio to encompass a wide range of businesses and services in the film, property, e-commerce, and media sectors. China Star Entertainment Limited market capitalization of $15 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that China Star Entertainment Limited holds a significant advantage in their industry. China Star Entertainment Limited trades at a higher price-to-book ratio of 7.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. At the same time, profits have grown exceptionally fast while the share count has declined. This suggests management is generating substantial earnings while actively concentrating value into fewer shares, an extremely positive signal for long-term investors. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and varied across different business operations. On the growth side, the company has seen significant increases in revenue from multimedia and entertainment business operations, property development and investment operations, sales of properties, artist management service income, catering operations, retail sales, and the launch of its Iviwell healthcare product. Additionally, the company's restaurant operations at Tiffany House have also experienced a notable increase in revenue. On the decline side, however, the company has faced significant challenges from various sources. The film-related business operations have seen a substantial decline, as well as property development and investment operations. Revenue from sales in Tiffany House has decreased, and the company has also experienced a decrease in commission margin and income from traditional live streaming due to increasing competition. Furthermore, the residential property market decline in Macau has had a negative impact on the company's revenue, with 9% fewer transactions and price drops. The downward trend of property prices in Macau has also led to write-downs of stock properties, including Tiffany House and Property C7. Overall, these factors have contributed to the decline in revenue, while the growth drivers have been largely driven by diversification into new business areas and expansion of existing operations. The net income of a company experienced an 8% decrease from $841,000 in 2024 to $67,123,000 in 2025. This decline is primarily attributed to a significant loss incurred due to the write-down of stock properties, amounting to $15,247,000. The profit margins also underwent a notable change. The multimedia and entertainment business segment witnessed an increase in revenue from HK$50,788,000 to HK$179,810,000. However, this growth was accompanied by a decrease in the segment's loss from HK$55,780,000 to HK$15,247,000. The improvement in profit margins is expected to continue with the launch of the Ivuel product in 2026. This anticipated development suggests that the company is poised for future growth and increased profitability. The company's debt level has experienced significant growth over the past year. According to the financial reports, total liabilities have increased by 35.3% from HK$151,111 to HK$908,930. Furthermore, the debt level has risen by a substantial HK$419 million compared to the previous year. However, there is an inconsistency in the interest expenses reported. On one hand, interest on bank borrowings has decreased by 43% from HK$116,063 to HK$66,043. This suggests that the company's financial costs have been reduced. On the other hand, interest on other borrowing has increased by a staggering 164%, from HK$41,478 to HK$109,632. Additionally, finance costs have decreased by only 26% from HK$134,827,000 to HK$100,154,000. This discrepancy highlights the need for further investigation into the company's financial management practices. In conclusion, while the debt level has increased significantly, the interest expenses reported show mixed results. The decrease in interest on bank borrowings is a positive sign, but the substantial increase in interest on other borrowing and the relatively small decrease in finance costs raise concerns about the company's ability to manage its debt effectively. Management emphasizes the importance of employee quality in upholding the company's reputation and driving profitability. They recognize that exceptional staff are essential to maintaining a strong brand image and ultimately boosting revenue. In line with this focus on quality, management has made a strategic shift towards high-end healthy products in their Chinese business operations. This new direction is expected to have a positive impact on the company's bottom line, as it will require fewer employees to manage, thereby reducing operational costs. There are concerns about inventory buildup and supply chain disruption. The company's financial records show an increase in inventory levels from $307,769 in 2025 to $28,481 in 2024, indicating a significant buildup of stock. This trend is further supported by the poor box office and revenue performance of a film released in 2024. The film's underwhelming success may indicate issues with production or distribution, which could be contributing to the inventory buildup. That concludes the financial summary for China Star Entertainment Limited. Feel free to comment below, and I will be happy to answer them when possible.